Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Asana. Asana is a workflow management platform. It reported its results last week, Q3 2022. It has its fiscal year and calendar year misaligned. I'll be referring only to its fiscal year unless I tell you otherwise. So there are a lot of good points and bad points. So the good point is that Asana has an amazing platform with strong customer adoption, and it's rapidly growing its revenues. The bad news is everyone already knows that, and that's well and truly factored in to its valuation. So here's the thing, right? This is the share price in the last several weeks. You can see the stock has just been obliterated despite it reporting strong results. Now here's the thing. I said 2 weeks ago, before earnings come out, you can check out in the original article, I said, in the absolute best case, the stock is priced at 50 times forward sales. I know that with Asana's shareholders, that they believe that this time is different, but it's not. Valuations actually do matter. And as it transpires, earnings came out, Asana couldn't live up to its hype, and as it transpires, things just sold off. And to be absolutely clear, I was an unwavering bull of Asana since last year's November, and I saw the share price go up 300%, and I kept being a bull. And then in November I said, okay, enough's enough. I can't validate this valuation anymore. So anyway, let's dig into the quarter. So results, the revenue growth accelerated, really strong. The guidance for Q4 is again very strong. They're probably even being conservative here. They're probably going to smash through this, and it's got a very strong tailwind to its back, because even as other platforms in the work from anywhere environment are kind of slowing up their growth rates, Asana continues to plow forward, and Asana is growing at even into fiscal Q4 2022. It's pointing towards 54% year-over-year growth rate. So this is very strong, and this is what I said 2 weeks ago. I said I fairly suspected when Asana reports their Q3 results in the upcoming 2 weeks, Asana will not only beat its guidance but raise its full-year outlook further. And that's precisely the problem. I expect this already. That means you expect this already. That means it's already priced in. And what happened? That's exactly what happened. They beat on the top, they upped their guidance, and no one cares. So why Asana, right? So Asana has a lot of tailwinds to its back. It's a really well-positioned platform. As you work in this kind of environment of dispersed workflow, often you're going to be working with people that you've never met before, but you still want to know who's accountable to do what by when, and that's really important. And that's why Asana has very high returns on investments for their customers, well into the triple digits. So you can see here, so the number of customers spending 50k a year on Asana was up 132% year over year. So they're clearly growing at a very rapid rate. Just for context, Monday.com, which is a peer of Asana, they just reported their results. For customers spending 50k, they were up 232% year over year. By most reasonable estimates, Monday.com will overtake the large customers of spending on Monday.com will be higher than on Asana. I mean, that just probably next quarter, if not by next quarter, the quarter after that. Nevertheless, Asana is evidently resonating very strongly with customers and provides them a lot of visibility to be able to coordinate, as teams are kind of working, some work from home, some in a hybrid work environment. It's their ability so you don't have to chase around who's doing what. You can actually just get down and do higher value added work. So this is really strong, and that's why you're seeing such a strong customer adoption rate. So now let's discuss one of the blemishes here. So Asana's Q4 is guiding for negative 48% non-GAAP operating margins. If you think about it, for the 9 months of this year so far, its non-GAAP operating margins were at 42%. So it's pointing that even as it's growing faster, it's becoming more unprofitable on a non-GAAP basis. The free cash flow margins are pretty much the same. So for Q3 was negative 29%. This is a slight improvement of 400 basis points to the same period a year ago, but for all intents and purposes, it was negative 29%, kind of consistent with the previous 9 months. So on a rule of 40, remember the rule of 40 is telling you as an investor how well management is balancing the act of growing its revenue while being profitable. So you want to kind of hit around that 40. That's kind of like in the SaaS world, it's kind of what you should be aiming for, and it fares quite poorly on this. It's practically at the 40 range. So you're kind of paying a premium here, and you kind of expect it to be really outshining on every metric, and I don't think it is anymore. Now, here's the thing, right? It's difficult to value Asana, right? So Asana presently is priced at approximately 13 billion market cap, okay? If we make the assumption that what analysts are expecting for next year, that Asana just blows through that, okay? So for fiscal 23, over the next 12 months, Asana actually grows at 40% CAGR. That would put its revenues at 520 million, okay? That would imply the stock is priced at 25 times forward sales. Now, back in the summer, this made a lot of sense. Paying 25 times forward sales for a business growing at 40, okay, yeah, you can make that argument. You could throw in some dollar-based net retention rates, and you could build an argument there. But in this market right now, why would you bother paying 25 times forward sales when you can look around and man, everything is just thrown like into the bargain basement? Now, just for context, Monday.com is priced at 27 times forward sales, which is pretty much the same as Asana. So you could say, okay, Monday is also priced at 27, so it makes sense to pay for Asana 25. Well, first of all, Monday.com is growing meaningfully faster. Second of all, Monday.com has much better profitability profile. I don't have a position in any of these stocks, but I'm just highlighting this is the fact. Now, investing is so easy in hindsight, and the reality is that it's really tough to be able to have some kind of insights going ahead, and that's why investing is so fascinating, because it's all these kind of nuances. And as I said many times before, I was particularly bullish on Asana when the valuation makes sense. But given that so many small and large cap companies, small and mid cap companies are now trading at a 52-week low, I mean, it makes little sense to deploy more capital into this name. But if you want to find out what kind of names I'm particularly excited about right now, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor, help you think through investing, and yeah, I hope to see you soon. Okay, bye-bye.